The Mortgage Experts, brought to you by AmeriFirst Financial, an equal housing lender. NMLS number 145368 and MNLS 114448.
It's time now for The Mortgage Experts with Jim Dildine, brought to you by AmeriFirst Financial.
Once again, welcome to The Mortgage Expert. Jim Dildine in studio with AmeriFirst Financial, our mortgage expert here. Jim, welcome back.
Thanks, Dave. It's good to be here with you.
You know, I started thinking when I was at Thanksgiving dinner, we was talking to somebody who was getting ready to buy a house here within the next year. You've got a list of do's and don'ts, kind of specific do's and don'ts, don't you?
We do. Yeah, there's a lot that comes along with buying a home, getting qualified for a mortgage. Some of these do's and don'ts that we'll talk about today are pretty obvious. A few of the other ones are things that maybe everybody doesn't think about every day.
Well, let me slow you down before you say they're obvious. The average person, how many homes will they buy in their lifetime?
Yeah, maybe 2 or 3.
See, you deal with it every day, but for most of us, we'll do this 2, 3, maybe 4 times in our life. So they're not quite so obvious to some of us. So let's get started on, shall we start with some of the do's?
Absolutely. That's a good point. So the first do, we have 5 do's that we say that people should definitely do when they're looking at getting a mortgage. The first one is always get pre-qualified before you start shopping for a home. You have to come in and get pre-qualified before you start that process. As I was kind of preparing for this today, I thought of a client that I had come into my office. It's been probably 2 months ago. Dave, she came into my office and she was more excited than I had seen a client in a long time. She had been out shopping for a home. She made an offer on a home. The offer was accepted, and she thought she was moving into this new dream home 30 days from then. And she went on and on. She was telling me how perfect the home was for her family, about each of the bedrooms for her kids, how big the backyard was for her dog. It was going to be able to run around, and just thought it was the perfect home for her. And I was excited for her. We sat down, we took the application, pulled her credit report, and went through it. Her credit score was actually high enough to get qualified, but as we dug into the report a little bit, we saw that she had gone through a foreclosure a little over 2 years ago, and for the loan that she was trying to get, there was a waiting period from foreclosure date of 3 years.
Oh boy! And
so it was.
You had to crush her dreams.
I did. I didn't like it. That's not the fun part of my job. I thought of that experience because she came in so excited, and then had her dreams kind of crushed. Now it's not the end of the world because we sat down, we made a plan for her, and as soon as she hits that 3-year mark, I think it's 9 or 10 months from now, then she'll be able to go out and start shopping for a home again. But
had she gotten pre-qualified, she would have known right up front, not eligible for that kind of loan. Here's what you're looking for, and here's the dollar value you can spend.
Exactly. She would have known it all up front, wouldn't have gone through that emotional roller coaster of thinking she found the great home and then it getting put on hold.
So do number 1, get pre-qualified. That would be number 1. What's number 2?
Number 2. So this is one of the ones that I thought was kind of obvious, maybe or maybe not for everybody. So number 2, stay current on all your accounts. That means credit card accounts, student loan payments, your mortgage payments if you currently have a mortgage. All your current credit accounts, you got to stay current on those leading up to buying a new home.
If I've had bumps in my credit for whatever reason, minor bumps, 3 months before, 6 months before?
Yeah, it depends on the type of account that you're talking about. If you've had late payments on your mortgage,
that's the
current
worst.
Mortgage, that's the worst, and it's going to be hard if you've had one in the last 6 months.
A mortgage and or a second on a mortgage?
Yeah, when you're talking about a home equity line of credit or a mortgage, banks are going to look at a late payment on those basically the same.
Okay, so those are the number ones to make sure those are taken care of, and then the rest down from there.
Yeah, if you have to be late on something, make sure your mortgage gets paid first, and maybe if you had to, miss a payment on your credit card first.
If you're having to miss payments for a reason, you might want to rethink what you're doing at that point.
Sure,
really.
Sure. You got some other issues that you want to make sure you get worked out.
So. Okay, so pre-qualified, stay current on your accounts. Number 3?
Number 3, so we always say, do call your loan officer, do give me a call if any credit questions come up. And this kind of is going into the scenario of once you've applied for the mortgage or come in and got pre-qualified, At that point, if any credit questions come up, if you get a credit offer in the mail, your credit card company calls you and offers to increase your credit limit or to do something to your interest rate. If you get any offers like that, please give me a call and just talk it through with me, and I'll make sure that whatever's being offered to you is not going to be something that will negatively affect your credit score or your pre-approval.
Is that just because when things change in your credit score, it raises a red flag and slows everything down?
Yeah, it can. So there's a few things. When you have people out there pulling your credit, that can have a negative effect on your credit score. If you're opening new accounts, it can have an effect on things. So once you have got pre-qualified for a mortgage, at that point, you just want to be really careful in what you do in getting new credit, having people pull your credit, that kind of thing.
Anything changing there.
Correct.
Now, the next one, as I look at your list, number 4 on the list, this is something that may be a little more confusing for somebody who doesn't do this all the time. Number 4, what is it?
Number 4, I would say do lock in a low 30-year fixed rate mortgage.
Okay.
And you've probably heard different types of mortgages out there, a fixed rate versus an adjustable rate mortgage.
That's the one that they call an ARM.
An ARM, correct.
Okay, fixed rate, I get that. It's the same percentage rate from the first payment to the last.
Correct.
Explain an ARM.
So yeah, fixed rate, you get the rate today, it's never going to change. You're locked in, never changing. An adjustable rate mortgage or an ARM, the interest rate will be fixed for maybe the first 3 years or first 5 years or first 7 years. But then after that initial fixed period, the interest rate can go up or down with the market. So
now that's some of the loans that people got in trouble with here in the past few years. They had a low interest rate, suddenly it readjusted, they lost their job, the interest rate really goes up, and suddenly it's a disaster.
Yeah, there's a lot more risk involved in that type of a loan. So yeah, if your payment was $1,000 per month, say, and then you get past that 5-year fixed portion of the loan, and the rate jumps up 2 or 3% on you, and now suddenly you have a payment of $1,300 per month, and people got in trouble pretty quickly with those payments jumping up on them. So, in my opinion, 99 times out of 100 these days, with rates as low as they are on the 30-year fixed rate option, just go with that option. Just lock it in for the 30-year loan, for the full 30 years, where you're never going to have to worry about that payment jumping up on you.
Okay, so get pre-qualified, stay current on all of your accounts, all your bills, talk to your loan officer if any credit question comes up, good or bad. Lock in a low 30-year fixed rate mortgage. Number 5 on your list?
Number 5, it has to be find a good realtor to help you go out and find that perfect home. Everybody has access to the internet these days, and you can go out and search for homes on realtor.com or 100 different websites. But those websites, they don't always have the most up-to-date homes on there, or the best bargains, or all the foreclosure deals, or the short sale bargains that come out and are sold the next day. So I would say definitely do find yourself a good real estate agent who has that up-to-the-minute information on all the best deals and can help you get into one of those before they are taken up.
Which, as we've discussed before with Brent, who we're going to talk to here momentarily, it's not you as the buyer. It's not going to cost you.
Yeah, it's kind of a no-brainer for buyers. All the real estate costs are typically paid for by the seller. So as a buyer, yeah, it's not costing you anything. You might as well use the expertise of a realtor.
Let's run down the don'ts here. Number 1 don't you have?
So I'd say, number 1, don't seriously shop for homes until you get pre-approved. Kind of going back to that first item we talked about.
Okay.
And going along with that, I would say when you get pre-qualified, say someone comes into my office and I pre-qualify them we could approve them for up to $200,000. That doesn't mean necessarily they should go out and push that limit and go right to $199,999.
Because there's other expenses that come along with owning a home besides that monthly check.
There is. There's the utilities and property taxes, and the expense, fixing things up that will break occasionally. So there's other expenses. But I would say once you get pre-approved, then sit down, and look at your budget specifically and make sure that you're looking for a home that's going to give you a comfortable payment, not making you feel like you're scraping by every single month.
Number 2 on your don'ts?
Number 2, don't apply for new credit cards or have people out there pulling your credit report. And this is something we run into quite a bit. Once we pre-approve someone for a loan and they go out and they're shopping for a house, a lot of people will look at going out and buying furniture for their new home, or even they're not even thinking about it, but they go to J.C. Penney's and they're buying a pair of jeans and a shirt, and the bill's $80, and they offer them 10% off if they open up a credit card. That you got to stay away from those kind of things once you've been pre-qualified and you're working on closing your loan in the next 30 days or so, because if they open up a new account and pull your credit, that can have a negative effect on your credit score.
I get that. Now, your next one makes me scratch my head a little bit. Number 3 on your list.
Yeah, this is kind of one that's definitely not obvious to people, and one that kind of surprises people when I tell them. So we'd say once you get pre-qualified and you're working on your mortgage, do not pay off collections or charge-offs.
Why is that?
So it's kind of odd. Usually paying off debt is a good thing, right?
That's what I would think.
Yeah. So the way the credit bureaus work, say you have a couple of medical collections that are really old. They've been on there for 5 years from something that happened years ago. And now your credit score is up to good enough to get this loan, and working on it. Going to close your loan in 30 days. Well, if you go and you pay off those collection accounts, those collection companies will then report that to the credit bureaus. They'll report it that it's been paid, but to the credit bureaus, it will show up as collection accounts that have had some sort of activity on them in the last 30 days or the last 60 days.
So while it may have disappeared from the radar, paying it off throws it back up there.
Yeah, so it'll show a zero balance, but it'll show as a recent collection activity.
Okay, so if you have those and you really want to do the right thing and pay them off, wait till the loan closes.
Correct. I mean, you definitely want to get them paid eventually, but just don't. There's some timing involved. You don't want to do it right during the process of your loan.
And I would assume a similar thing with number 4 on your list. Don't close credit card accounts.
Yeah, same type of thing. Any changes you make to your credit profile, all your credit accounts, can affect your scores for the positive or the negative.
Okay, let me ask you this, because I have closed some by my choice, some credit card accounts. I just want them gone. I don't want the cards coming in every.
Sure.
How long until that really doesn't affect my score or show a negative to me?
Well, so it's not always going to be a negative effect. That's number one. But it's just something that you want to be careful with during the loan process.
That process. Okay.
But kind of the main thing that can do that, one of the factors for credit scores is takes your current credit balances compared with your current credit limits. And so if you close some of your accounts, your limits came down and your balance is a higher percentage of those credit limits. So it's safer just to keep, during the loan process, keep the cards open that you have open, and you can close those or do whatever you'd like after you finish up on the loan.
Which kind of goes hand in hand with number 5 on your list of the don'ts.
Yeah, and this one's maybe more of a common sense thing. Don't max out your credit cards. When you get your balance up right near the credit limit, that's one of the big factors that can bring your credit scores down. And so,
but that could, if you're thinking of buying a house, it might be easy to go out to the furniture store and go, oh, that would be perfect for the new. Let's go ahead and get that now while it's on sale and run those credit cards up.
Yeah, absolutely. And that's why we have that on here as one of our don'ts, because if you go max out your credit card and we have to do a credit refresh or look at your new updated credit scores, that can definitely bring the scores down a little bit.
Jim Dildine with AmeriFirst Financial with us today, the mortgage expert, as we talk about some of those do's and don'ts of getting that mortgage. Let me ask you a question here, and this really, we hadn't talked about this before, but I know during the whole, the beginning of the collapse of the home industry, there were a lot of people that were saying, I didn't know that's